So thanks very much. Great to see everybody again this evening. And so what are we going to try to accomplish tonight? 3 things. First, I'm going to do my best not to perform like the Leafs did in third period last night. We usually come with a hockey joke to start with, but the paint's too fresh, and quite frankly, nothing was prepared to be pushed through photocopiers in time to get here, as you can imagine, given what had just happened. The second thing we're going to, of course, try and do is just provide you some perspective on what we've been up to in collaboration with the board and the management of Tradex to try to continue to evolve in smart ways and pick good stocks in order to provide the best experience we can for you in sort of with a Canadian equity foundation in the portfolio and an emphasis on some flexibility to own the best of US and global stocks. So we'll give you some perspective on that. And then the most important thing from our perspective as well is to really say thank you to all of you and to express to you that, you know, tonight you have 2 of us with you, but there's a big team, a very large team that is working hard on the Tradex equity fund at our firm across the largest Canadian equity team in the country. The global team that we have is a fantastic global team, our foreign exchange team that works on the hedging side, and of course the office of our Chief Investment Officer and risk officers that are keeping a watchful eye on the portfolio and the portfolio managers. So everybody at our firm really appreciates this. It's been a very long-standing relationship, and we hope to continue to enjoy success with you for many years to come. So with that, since we're not starting with any jokes, unfortunately, I'll start off by just giving you some thoughts on the philosophical backdrop that we've often spoken to you about, and we try to think of key touchstones that we found over time that in practice can help us to try to navigate markets effectively and add value over time to your portfolio and do that in a smooth and repeatable fashion. And George Soros, I'm sure you probably had the chance to read this quote and you've seen it in the past, but he captured something that's quite true not only to markets but in life. When you think about watching whatever your favorite sport is, be it soccer, be it hockey, be it football, what gets people to jump up out of their chairs? It's the unexpected. Positive, the shocking goal that sort of seemed to come out of nowhere was just absolutely artistically done in a way you just never expected and seen before. Or maybe something that's, really unfortunate that makes us all want to drown our sorrows, like we saw last night in the third period, giving it away really badly in the 7th game. But those are the kinds of things that get us, up out of our seat. The same thing is true of markets. When you think of what you might have heard if you're listening to the financial prognosticators in the last couple of days, they would have been talking about Facebook blowing through earnings expectations. And that created a reaction in the stock. Boeing had some really phenomenal earnings, and that created a reaction in the stock. And then you see the other side. You probably read about GE and the problems that are happening there, what's happening to that stock. So when the market has an overall sort of consensus view of what's going to happen, it's really the unexpected. So the things that we can try to do to add value and smooth the process is to think about bottom-up fundamental research, really knowing our companies, having good industry expertise, and really understanding, therefore, what we think is embedded in the stock price and what you're paying for at any point in time can really help us calibrate portfolios properly. And also think about never standing still, always looking for opportunities. And one of the ways that we've really worked together and very much through the stimulation of Blair and the board, they're always thinking about, are there additional tools we can put in to work into to effectively build value for unit holders and give them a very unique experience so they can come to the Tradex equity fund and have a good experience in the equity markets. So with that, I'll try and provide you with a little perspective as I look back. On the left-hand side, what you're looking at is the annualized returns. Thankfully, that isn't the total cumulative return since 2011 for each of those indices. That is the annualized return. And what you immediately notice is, I think you'd be thankful that the Tradex management team didn't anchor the fund entirely to Canadian stocks. You'd be thankful if you own this in your portfolio, you didn't anchor yourself entirely to Canadian stocks over most of this cycle. Now the interesting thing is that if we roll back the clock and we think about sitting down and reading the newspapers in 2009 or 10, certainly the credit crisis will come to mind. One of the other things though that may come to mind is that Canada had this enormous glow. Obama was coming to office and talking about our healthcare system. The world was talking about the success of our banking system, how we had regulated our way through the crisis, how our banks had been much more stable. The Canadian flag was sort of strong and proud around the world, and the prior decade had been very kind to Canadian equities. We had been at the top of the leaderboard. So, the move that has been made, that we'll show you in a few minutes, was consequential to the ability of the portfolio to outperform what's actually happened in the Canadian equity market experience. The reason why it's happened, as everybody knows, is essentially captured to a degree on the right-hand side. So Canada tends to be a little very heavy in banks, metal stocks, and energy stocks. Global markets, particularly the US and in areas like Europe, tend to be much heavier in some other areas. So when you look at the four sectors below financials, information technology, consumer discretionary, healthcare, and industrials, that's more than half of the global market exposure, and it's less than 20% in Canada. So those have been areas that have done particularly well this cycle, and thankfully, what's happened with the flexibility of the mandate that we've been provided and encouraged to utilize by the board and the management team, we've recrafted the portfolio through both additions and also letting our exposure run with the growth we've enjoyed in foreign markets, and also building in new exposures. So when you look at sort of the portfolio circa 2011, it was 80% Canada, 20% US. One of the other things there, it was 100% North America. And so there was exposures indirectly that would have gone across continents, but there was no direct ownership of companies across the ocean. The change you can see on the right-hand side, so it's more of a 60-40 mix, and it's global in context, and there's even some emerging market equity in there. So a much broader opportunity set, and that's really been effective for the portfolio, we think, and good collaboration. One of the areas you hope for in life is you not only make some good decisions, but if you're fortunate enough, you maybe get lucky, and we were fortunate as a group that these decisions were certainly made at a time that ended up being fortuitous, because we've essentially, as you've seen on the prior slide, gravitated from our foreign equity exposure being mostly tied to the US, the success in the US, which was a terrific place to be in the front end of this cycle. So the scales on each of these slides are a little bit different, but what it's showing you relative performance means, so if that line's going up, it means that market is outperforming Canada. So it's basically the performance of, for instance, on the left-hand side, the US equity market divided by the performance of the Canadian stock market. And so you can see 150, where it got to, is an extra 50% return had you been exposed to the US versus the Canadian stock market. So the front end of the cycle was really kind to the US. That's where the exposure was. As we were making decisions to build out the opportunity set, hopefully wisely, but we got fortunate as well, because there's been a bit of a handoff, and especially recently into the emerging equity markets, which have also had some great technology titans. So that's been hopefully some perspective for you in terms of thinking about the philosophical tenet at the high level, and the board and the management team working with us on that perspective. When we think about the Canadian equity allocation, how do these philosophical touchstones play out in terms of what we're up to in the Canadian equity portfolio? Well, the Canadian equity portfolio is always, we've talked to you about in the past that, you know, at the end of the day, we're not an ETF, we're not an index. We believe that we can add value by trying to own the companies that we think have the best risk-adjusted return potential, and trying to de-emphasize the companies that we think have have less attractive characteristics. So on the left-hand side, you see somebody says active weighted. It really means where are we overexposed, where are we underexposed. So it's giving you a sense, for example, in the banking sector, we like Royal Bank, we like Bank of Nova Scotia. We think those have more attractive fundamental characteristics and valuations right now, and more attractive franchises than we think the National Bank has. And part of that even comes back into the global thing we've talked about. One of the other things when you think about what's the unexpected, you don't always want to bet on the unexpected. I mean, the market consensus, we're not suggesting is silly. There's a lot of relevance to understanding. There's everybody that makes up the sum view of what's embedded in the stock. That's a hell of a lot of intelligent minds. We're not suggesting that we're smarter, but we can potentially be more pragmatic if we allow ourselves to think broadly in terms of the full range of outcomes for stocks. We try to keep ourselves unemotional. Then we can hopefully try to apprise ourselves of where the market may have swung too far. Where we thought the market swung too far we've been early to think this, so we're just starting to get rewarded for this view, is in the energy sector. So you'll see on the right-hand side where we overweight right now from a sector standpoint. This is coming from bottom-up security selection. That's in the energy sector. And so one of the questions we could all ask, especially given that lots of the headlines, coming from the West are not particularly happy right now, is why would we be overweight the energy sector? And so it relates back to that Soros comment, which essentially is saying, well, the market's had a very dreary outlook, particularly for Canadian oil. So we all know about, the bad list, the things that have made the market run away from energy stocks. And so there's lots of them there, whether you think about the pipeline debates going on in Canada, which means we can't get energy out of the country at a good price, all these kinds of things, issues around NAFTA. So lots of the bad news is there. Now, we tend to see on the left-hand side, you can see when you look at the valuation column, a lot of that bad news, as you can imagine, when it's so common, gets embedded in the stock price. So people are reappraising the stocks, and in fact, if you went back home and you pulled up Yahoo Finance or whatever you use, Google Finance, and you pulled up any of the energy companies, look back over a few years, it's not a pretty picture. These stocks have been drifting lower, and they're just starting to show some signs of life. So a lot of bad news when that's happening is getting embedded in, because if you think about the energy stocks versus the price of oil, price of oil is starting to recover right now. These energy stocks are still under a lot of pressure, so they're clearly out of favor. And when management teams, good ones, are put under that kind of pressure, some good things can happen too. So in the good column, you'll see we talk about the potential to cut costs, some more disciplined capital allocation. So those are some of the good things that can ultimately start to create the tinder, if you will, for a turn. And what that turn finally needs is some catalysts. So we try to think about, as we balance this out, what are the catalysts? And this is a list we've had for a while. Truly, before we got all these catalysts starting to light up in the right direction, hopefully they are right now. The truth will be known this time over the next couple of years. But what we've started to see is that moving in the right direction. Were there some negative, unexpected things that happened before we got there? For sure. But you're starting to see some of these things move in the right direction. And I'll give you a sense for an example of one that's probably easy for all of us to relate to, which is, we know with anything, that when you have a supply glut, when somebody's got a massive inventory, think about any shopping store you want. When there's a massive inventory of something, the price for it falls. And so clearly there was an inventory problem in the world in terms of oil. There was too much supply. We've seen that correct itself, and Canada's been later to really be able to capitalize on that, because there's the takeaway capacity in Canada. There's been some bottlenecks on that, but you're seeing a recovery in that glut. And so that's one of the key things that gives you a sense of how the catalysts are starting to turn. So that gives you a flavor of why we're positioned with the overweight in energy. How are we doing it? Well, essentially, what we're trying to do is be wise to the fact that, again, you know, if you take George Soros's quote but have some humility about it, we don't know. You know, we certainly don't have a crystal ball for what the energy price is going to be any particular day, exactly when these catalysts will come that we anticipate. But we do think that, you know, there's some sense in trying to position ourselves for it along the lines we've described, and doing so with companies that we think will survive. If the valley's deeper than we expect, if it's longer than we expect, we want companies that we think will survive. And then we want to build into the portfolio, to give you some sense of how we think about, you know, constructing a portfolio, some breadth that's going to help us in a few different ways. So on the left-hand side, we've got integrated energy companies, and so you want to think about when you go to the Petro-Canada gas station, that's Suncor actually owns that. And what it really means is, because they're vertically integrated, they're more sheltered from the ups and downs in the oil price, because they change the price at the pump. So they kind of, you know, they're able to insulate themselves. So those companies are producing a lot of free cash flow. They're able to move across really tough environments. So that gives us some insulation in the portfolio. And then we've got some opportunities for upside when we look at the high quality producers and the junior and mid-cap exposure. But again, we're focused everywhere on all the qualities that are at the bottom there. So the kinds of companies that we think are really going to be able to weather the storm and be able to produce free cash flow, not require financing in the worst of times, and get to the other side. And then they'll give us a lot of leverage if things turn out the way we hope they will. Another, you know, so we talked about the energy sector. Another one of the things that Tradex and the board and the management team asked us to accentuate in the portfolio is the ability to capitalize on our market position. Being the largest in the market does have its benefits, and so when we see an attractive initial offering, so this is a company coming public, and this is a company you're probably quite familiar with. When you go to the drugstore, assuming many of you take vitamins, even if you don't, you'll be quite familiar, I'm sure, with these brands. This company is a Canadian company that's been, has not been a public company, but been around since 1922. It's got 25% of the market in that nutrition supplements industry in Canada, and it's actually in 40 countries around the world. As you can imagine, it's a pretty good business given the focus on healthcare around the world. And so we were excited to get a position. This was an oversubscribed, so there was way more demand for the stock than when there was stock supply. We were able to get a full position in it for the portfolio. And with that, I want to turn it to Beecher to give you a sense of what we're up to in the global side.
Thanks so much, Andrew. I'd like to echo Andrew's comments as well. Thank you so much for having us this evening and allowing us the opportunity to present. It's a real pleasure. So in terms of the global portfolio, we have a snapshot on slide 14. There are a lot of numbers on this slide and pie charts and other things. And so what we thought we'd do is we'd step back for a moment and just think, what's the real objective of this portfolio? And if we really get down to it, the objective of this portfolio is really to own great businesses with leading competitive dynamics. That's really the backbone of what we're trying to achieve here. And so that may be easy to say and easier said than done. And so you could think, well, perhaps there's an opportunity set out there in terms of the index, which you can see on the left-hand side, just over 1,600 stocks. And then if you think about emerging markets, because we're not limited to just developed markets, we're getting to just over 2,500 stocks now. And so if you think just above that, you can see 33 positions. So I think that really does speak to our discipline and how serious we are about only owning the best companies within this portfolio. In terms of one other thing that's quite interesting in terms of this portfolio is that if you think about other management teams, and even in our firm, as Andrew talked about risk management at the beginning of the presentation, that's one thing that's absolutely critical to this portfolio. And so within it, we have 3 individuals, amongst many others that are stock picking and doing portfolio management, but 3 individuals specifically that all day, every day, focus on nothing but risk management and sizing the positions, ensuring we have the right sector exposures, we have the right country exposures, and so that allows us to have a concentrated portfolio of only the best ideas in order to achieve success. One thing you'll note on the right-hand side of the slide there, we've highlighted is emerging markets. And so in the past, emerging markets for Canadian investors at least hasn't been an asset class they've necessarily felt they've needed to own. And the reason being is that the 2 markets were so highly correlated and largely resource dependent. And so when resources went up, both markets in terms of Canada and emerging went up, and when resources went down, both followed suit. But as we fast forward the clock, and as we can see on this slide, we look to 2017, the markets now look very different. And so one number I'll draw your attention to is information technology, which is the 2 middle bars, as you can see there. And so Canada, even though we have a growing information technology sector, is still at only 3% of the overall market, so quite small. Whereas emerging markets is at 28%. So their IT sector is rivaling how we would consider financials in the TSX market. So again, that opportunity set, having the opportunity to go into those emerging markets and exploit that diversification and hopefully add value to the portfolio is really key. In terms of overall performance, we can see that on slide 16. And on the left-hand side, you can see sector contributions to the overall portfolio. And here, what we would hope to see is broad-based contributions. And so, in terms of performance, we'd hope that not 1 or 2 or even 3 sectors are contributing, but all the way down, as you can see, that we get that broad-based contribution. And so, on average, over the long term, we hope 6 to 7 sectors in terms of performance would be very strong, as it's not easy to do. But this year has been a very successful year for the team, as you can see, outperforming in 10 out of 11 sectors. On the right-hand side, you can see the top and bottom contributors in terms of performance. And again, broad-based in terms of the securities, and so we have staples, healthcare, industrials, and IT in there. And so it's not just one single stock that's really driving performance, but again, very broad-based. One number that's not on here is the contributions in terms of stock picking. And so that's an area that we really emphasize within this portfolio because it's a repeatable source of value add. And so judging when things like oil or gold are going to go up, or perhaps China is going to be successful, or the US, that's very difficult to do on a repeatable basis. Perhaps you'll do it successfully 1 or 2 times, but over the long term, that's very difficult. So where we focus on is on security selection. And over the long term, in terms of this period here, what we saw is 90% of the outperformance actually came from security selection. So that's also very positive for the portfolio. We are going to look at a few of these names in closer detail. So specifically, we're going to look at Estée Lauder, Intuit, and firstly, actually, NIDEC. And so we were speaking earlier, Andrew and I, it's quite interesting that some of these companies, you'd actually look in terms of the list that we own within the portfolio, and they may not be familiar at first, but once you find out a little bit more in terms of what they're doing beneath the surface, you realize that we probably actually use some of these companies and services and products in our everyday lives. And so we actually got here this morning and we rented a car. When we got in the car, first thing I had to do was adjust the seat. I had to adjust the steering wheel, rolled down the window for a little air, and unfortunately it was raining, so I had to flip on the wipers. But all these little things within a car actually use tiny little motors, which we all probably know. And so Tradex is actually an industrial Japanese company that focuses on precision motors amongst many other things. And so as we see increasing electrification in our daily lives, this is a company that's obviously benefited from that. Intuit, again, is one of those names that perhaps if someone just said, you know what Intuit does, some people say, I'm not quite so sure. But come tax season, you're probably more familiar with them. And so they provide software and financial management services in terms of TurboTax and QuickBooks and things like that. Intuit, with the growing North American small business market, has done very well, and they've also started to expand into global markets, which is beneficial for them. And then finally, Estée Lauder. And so some of us are probably more familiar with Estée Lauder than others, but they're a US consumer staples company. And what they have is they have really a successful portfolio of about 25 different brands that offer various cosmetics, skincare, and makeup products. And as you can see there, beneath the website picture on the left, you can see Clinique, Aveda, and MAC Makeup. And so those are just a taste of some of the brands that they have in the portfolio. And really, as we've looked to the retail space over the last 2.5 years or so, it's been under quite a bit of pressure. And so the traditional brick and mortar store has not done tremendously well in terms of performance. But Estée Lauder has really bucked the trend on this, and they've had a very successful year or so. And really, the key drivers here would be, one, they were early adapters in terms of e-commerce and making that transition to online sales, which is so vital to them. And two, beyond developed markets, they have tremendous growth within emerging markets, and specifically China. So that's been very successful for the company. In terms of these three examples that we spoke to here, or any of the companies within the global portfolio or the Canadian portfolio, one of the key things that we look at in terms of those competitive dynamics that we spoke to is ESG and management. And so ESG is just an acronym for environmental, sustainable, governance considerations. And that's really top of mind for us in selecting these companies. And so there has been a lot of talk about ESG over the last year or so, so we thought we'd do a little bit of an intro to ESG and in terms of how we think about it for these portfolios. And so typically when you say ESG, sometimes it'd be confused with, and I'm going to throw another acronym at you here, is SRI, or socially responsible investing. And the two do have some overlap, but they also look at things very differently. So socially responsible investing would be value-based investing. And so if you don't believe in owning perhaps a tobacco company or an alcohol company or a gaming company, that would completely screen it out of the portfolio and you wouldn't be allowed to hold it. So that's SRI. What ESG is doing is looking at those things like the environment, sustainability, and governance, and really looking to see, are there opportunities here to add value, or even more important, are there risks that we need to consider in selecting these companies to go into the portfolio? And that's how we think about it in terms of really contingent assets and contingent liabilities. On the contingent liability source, you can think of these companies, when they're cutting corners, really borrowing from the long-term success of these businesses. And so if you were a business, what you wanted to do is boost profits in the short term, you could cut training on your staff. You could stop investing in terms of product innovation, R&D, and customer service. You could not pay your dues to the environment, ensure that you're operating in a responsible manner. So in the short term, if you cut back on all these things and you borrow, you may be able to boost profits, but your long-term sustainability is absolutely going to suffer. And those aren't companies that we want to have in this portfolio. Companies that we want to have in this portfolio provide ESG opportunities, are continuously investing in their businesses, their customers, their employees, and really to have a collection of these companies is no doubt going to be a much better recipe for success. And with that, I'll pass things back to Andrew, and he's just going to cover off performance and finally the outlook.
Okay, so what we thought we'd touch on is, one of the questions we can all think about is, what's the value in stock picking? There's lots of literature. All of us read today that basically, says, look, you can just buy the index. And there's a role for that in your portfolios. One of the things that Tradex has asked us to do is to be different than the index. So, can what we're doing be replicated? Well, the number one thing you're going to find is, from a very high level perspective, the short answer is no. And purposely so, because we've been asked to do it, but it's in our nature. So when you look at the underlying composition today of the Tradex portfolio, and you think about Canada, global stocks, emerging market stocks, and so the universe of stocks that we're choosing from and trying to find the right opportunities for the portfolio from, that's on the left, so that's 2,700 stocks. And then on the right is the portfolio that we put together for you that ultimately has about 110 stocks in it. So if you think about that, it's essentially saying 96% of the choices that are out there are not in your portfolio. So in some ways, if you wanted to diversify within these markets, the indexes would provide a diversifier, but they certainly wouldn't replicate what we're doing. And that's on purpose, because I think there's a blend of various strategies you can use in your portfolio. So this clearly is about stock picking. So stock picking and then being adaptive about what we're doing in terms of the universe and the tool sets that we're trying to capitalize on to make that work. So the question for all of us is, does it work? And we like to think the best way to think about that is, you know, the 1 year was very strong, but over the cycle is a better way to look at it. We're all investing for the long term. So, you know, to be fair, we'd encourage you to look further out. But, you know, if you ask yourself, is that working? Well, clearly, we're not going to be able to choose the 4% of the universe that is going to run circles around the underlying universe of stocks or those index funds you might be able to buy. But hopefully, we're going to earn our keep by purchasing the ones that are going to do better and with a smoother pattern of returns over time. And so when you think about this, there's a couple of different ways we can measure it. One is against your core universe, the TSX. And so, you know, the question becomes, if you had a portfolio composed of just the Canadian universe and Tradex hadn't provided us with the latitude to go elsewhere, how has your experience compared? And so you can certainly see that latitude they provided us with has allowed us, thankfully, to beat the Canadian stock market and do so pretty consistently. But then the other question you can say is, okay, well, we have a much broader opportunity set than the Canadian stock market does, so how do you do against your peers that also have that same opportunity set? So this is how the Tradex Canadian Equity Fund is doing against what's called the Canadian Focus Fund universe. And those are all the Canadian equity funds that are allowed to own up to 50% in foreign stocks, like the Tradex Equity Fund. So that's your apple-to-apples comparison of us against the competitors. And so again, if you ask yourselves, are you beating your competitors by a good margin? You're beating them consistently? The answer is yes. And there's two things that go into that. Hopefully, a number of the things that you've heard about already this evening. The second one is probably what Blair would have referred to in his opening comments, which is what an excellent job they do on the cost side, because all of these are after fees. So this is a performance net of fees. Of course, the benchmark isn't free either, but we compare ourselves as if it is. And on a net basis, things are going well against both of the reasonable peer sets that we can use. So then finally, many of the comments we'll get over time will suggest that there's some interest in knowing what we think the outlook holds for stocks. And that's the toughest question to answer because none of us have a crystal ball. We really don't believe in trying to build one. We really think about holding the stocks for the long haul. Has worked out really well over time, and if we can just accentuate bottom-up security selection, things will go okay. So there's another reason, and that is really because the graveyard of people who used to wear suits and ties is filled with those who thought they could predict when the next bear market or bull market was going to start. So most people professionally don't think it's anything other than a hazard either. But I will give you a couple of thoughts, and you can build your own conclusions from. And so there's, as you can imagine, lots of potential reasons for some extra worry right now. We've seen an exceptionally long bull market cycle. We've just started to see some bouts of turbulence come back to life at the end of this chart, as you can see. And of course, we have some interesting characters cooking things up globally in terms of their plans to master the world. And so there's heightened geopolitical anxiety. One of the things that we think is a useful way to look at the current environment is to recognize that this is measuring the volatility, so the variation in stock prices is a simple way to think about it over time. And we've tried to capture different periods in different markets. And what you'll see is that in 2017, the bar was really small. So the equity markets were very placid, and in fact, exceptionally so. The most placid and quiet they've been in 50 years. They essentially were going just up and steady like the side of a triangle, and there was very little volatility. And And that is lovely, but it's probably not sustainable. You can see that even the prior 3 years, which had very little volatility in them, were still, substantially more jarring. And then in the last, when we look over the long haul, you can see that volatility has traditionally been, 3-4 times what we've experienced recently. So when you look forward, one thing we would anticipate is more of what we just saw recently, which is more turbulence. After periods of low volatility, you usually get periods of more volatility. Does that mean it's all over? No, we don't think so. We do think we're late in the cycle. We do think it's a time to be more cautious in terms of your asset mix and have the appropriate conversations with the team here about, your long-term goals and what the appropriate mix should be. But the signals we're monitoring, and the team in our Chief Investment Officer's office is monitoring about 300 really important and useful signals of market activity and economic activity. And for the equity markets, we think 30 are quite useful, and we boiled them down as simply as we can into an indicator to give you a sense of what we're seeing. And right now, with the line going up and in a healthy position, and you can also see sort of green light, red light on the right-hand side, we think we're still in a constructive environment for equities. Is it the best? The answer is no. If I could, probably can't use, is there a pointer on this? Do you know?
Should be.
Right at the top, is it? Oh, there we go. Okay. Well, this right in here is the most ideal time. If somebody was going to be loading up on equities, when you come through a hell of a tough period for all your indicators and you start moving up sharply. So we experienced that already. Up here is clearly things are getting, somewhere in that realm of we're as good as it gets. That doesn't necessarily mean it's all over though. We'll be more concerned when we start, pushing back down towards this red line. So lots of green lights still. The other thing, that we would highlight to you is that, we're late in the cycle, yes. Should we be cautious? Yes. Should we try to time markets? No. Whether it's this chart or there's a whole raft of them we could show you, it's a very difficult exercise. And, those who have tried to time the market, you could probably remember how many people have been telling us what over the last, pretty much every year of the cycle, every month of the cycle, somebody's telling you, get out now, it's all over. And they've left a lot of gains on the table. We're not suggesting that, that you should put everything you have in equities, but stick to your plan. And this is a time to be more cautious, for sure. But we don't think that you ever want to eliminate equities from your portfolio. And so with that, we want to, leave you with some summary thoughts, but thank you very much for your attention and also your confidence in our ability to manage the portfolio.